So you've worked hard your whole career ensuring that children become educated. As a benefit for this work, you're going to receive a pension when you retire. Now, it may look different to how you expected it to be, but it's going to be there. But what happens when you pass away and your survivors become eligible for benefits as well? Will it happen the way you want it to? Hi, my name is Dave Grant. I am a certified financial planner, and I am the founder of Finance for Teachers. Thanks for joining us. Now, beneficiary designations they can be somewhat of a minor part of the plan because they're not going to affect you in your lifetime. However, if they're not done correctly, they can have a big impact on your dependents. These people that survive you may not have a comfortable time if you don't do the correct job today. So let's look at some things that you should do to make that journey more comfortable. So here's the first tip. After every major life event, review your beneficiary designations. So you may have beneficiary designations on your pension, on life insurance, on other insurance products, and on retirement accounts. Chances are in these life events, so for example, they could be marriage, divorce, death, there could be people listed on those accounts that it's no longer applicable that they're there. So review it, make any changes if necessary, and then move on. The second tip. The wrong type of beneficiary is listed on your accounts. Now here's where it gets a little complicated. Now for a lot of accounts, you can list people or you can list trusts. And for estate planning reasons, sometimes it's better to list a trust than it is an actual person. Don't make that mistake with your pension. If you list a trust as a beneficiary, the only people that can be a beneficiary of that trust is a dependent child at the time that you die, or someone who is disabled. That's the only type of people that will get paid the monthly benefits if they're a beneficiary of that trust. If it's your 3 children who are beneficiaries of that trust, they will not get the monthly survivor benefits. Now the third situation, and here's something I come across somewhat frequently, is there's no beneficiary listed. Now sometimes it's getting harder and harder to do this now, because if it's a retirement account, you have to list one if you want to open that account. If it's your pension, TRS has now incorporated a default that it's going to be your spouse or your dependents. But what if you don't want it to be your spouse? What if you just want your pension to go straight to your dependents? If you haven't got it listed, it's not going to happen. So you have to make sure that you've put down your wishes in your beneficiary designations. Now the fourth thing, and this again is a little complicated, and it's just a life occurrence that happens that starts to make things get messy. It's when you have 2 different types of people listed as the primary beneficiary. So let's do this as an example. Mary's the teacher, and she has 2 children. She's not married. She has a 17-year-old daughter and a 5-year-old son. 10 years moves on, she retires, but she passes away immediately. When she was teaching, her children were dependents. Now, her daughter, who was 17, is 27 and married. She's no longer dependent. Her 5-year-old son is now 15. He's still a dependent. Now that she has beneficiaries listed that are of 2 types, so a dependent and a non-dependent beneficiary, that's where the mess comes in. In that type of situation where there are 2 different types of beneficiaries, in this case a dependent and a non-dependent, there is no option to have the monthly survivor benefits paid out. It has to be a lump sum. So in the case of Mary and her children, her 15-year-old son is now going to get a lump sum of cash, and who knows what's going to happen then. So that covers some of the major things that I see and some of the things that can cause problems. There are other intricacies that come in that can cause problems as well. For example, if you're a blended family, how does that happen? How do you leave it and split your pension between two different sets of kids if that's the case? What happens if you're a young teacher? There are certain provisions in a pension that do not pay out before the age of 50. There are lots of these different clauses in the TRS pension plan. If you're looking for more answers or if you want to go into more detail, we'd be happy to help.